Let's talk about NVIDIA's current valuation. Is this truly a golden ticket for generating alpha, or are we staring into a systemic liquidity trap? While retail investors are still glued to GPU shipment data, frantically queuing up to buy the dip, top-tier institutions on Wall Street are executing the exact opposite maneuver, a massive sector rotation. This isn't just a technical correction, it is a structural retreat. Deep in the dark pools, smart capital is decisively exiting the pure hardware trade. So who is left holding the bag? It's the late-cycle retail investors, perhaps even some of you watching this, who are still using linear extrapolation to fantasize about another 10x return. If you are feeling FOMO, fear of missing out because you missed the NVIDIA train, it means your focus has completely drifted from the macro narrative. The trading logic for 2025 is already priced in. In the eyes of smart money, capital allocation has already shifted to the new macro narrative of 2026. Today, I'm not going to just throw a few ticker symbols at you for speculation. Together, we are going to deconstruct the asset allocation strategy that investment committees at top firms are plotting right now. We aren't just talking about buy what, but the macro why. We are going to explore three invisible sectors poised to take the baton from the Magnificent Seven and deliver the next wave of asymmetric returns over the next 5 years. These sectors are currently on the left side of the adoption curve, just like Amazon in 2010 or Apple in 2003. To see the full picture of this cycle, we need to revisit the valuation bubble of the year 2000. If you were walking down Sand Hill Road or standing on the floor of the NYSE back then, every dollar was chasing the same beta. Who is the infrastructure hegemon of the internet age? The consensus was shockingly unanimous. It wasn't Amazon, which was just selling books, nor the startup Google, it was Cisco. In that cycle, Cisco's market positioning was identical to NVIDIA's today with even higher implied volatility. The bullish logic was simple and seductive. The internet is a deterministic trend. Everyone needs to connect, so they must buy Cisco routers. No matter which .com company wins, they all have to pay the toll to Cisco. Driven by this logic, Cisco briefly became the most valuable company in the world, surpassing Microsoft. But mean reversion is the iron law of the market. If you went long on Cisco at its March 2000 peak, do you know how long your drawdown recovery took? 20 years. Why did the valuation collapse? Was the internet story over? Of course not. It collapsed because infrastructure build-outs hit a physical wall. Once the fiber is laid and hardware penetration peaks, explosive growth inevitably hits a growth wall and turns into a zero-sum game. When the shovel becomes a commodity, selling shovels is no longer a high-margin business. But, and this is the core alpha of today's briefing, the long-term trend of the internet did not end in 2000. Quite the opposite. While Cisco's stock went sideways and countless investors left the market in despair, true value creation was just beginning. Amazon used that cheap bandwidth to reshape the global retail supply chain. Facebook used network effects to connect 3 billion users. Netflix utilized high-speed fiber to disrupt content distribution. We define these companies as the application layer giants. They only began to monetize at scale after the infrastructure capital expenditure cycle ended after the roads were built, creating returns on investment in the thousands of %. Right now, history is rhyming in a startling way. Let's recalibrate our sights to the AI sector. Look back at the last 24 months. Microsoft, Meta, Google, Amazon, these tech giants have poured hundreds of billions into GPUs and data centers. This is the fastest, most capital-intensive build-out in human history. Just like the fiber boom, the roads are built, and we are already seeing localized oversupply in computing capacity. Now, fund managers controlling hundreds of billions in AUM, assets under management, have run out of patience. On earnings calls, they no longer care how many GPUs Mark Zuckerberg bought or clapping for Sundar Pichai's demos. They are grilling management with the most piercing question. Show me the free cash flow. You spent $50 billion on infrastructure. Where is the ROI? When will these silicon assets translate into net profit on the profit and loss? This immense pressure from the capital markets is forcing the entire tech industry into a violent pivot from the cost-as-no-object capital expenditure phase to the ruthlessly pragmatic application phase. Therefore, my fundamental thesis is that 2026 will be defined as year one of AI application. This time, we aren't looking for the shovel sellers. We are looking for those who use low-cost compute to mine alpha. After quantitatively screening thousands of reports, I have locked onto three supersectors standing on the eve of explosion. Sector 1, Vertical SaaS, Services Software. The first source of alpha is hidden in the seemingly boring world of B2B enterprise services. There is no consumer traffic hype here, but there are incredibly wide moats. You might be familiar with SaaS software as a service, like Salesforce or Adobe, but Wall Street's current investment theme is a new paradigm, service as software. Note the difference. This isn't just swapping words, it's a business model revolution. In the old SaaS era, clients bought software for efficiency. You bought tax software to calculate faster. You paid a subscription fee. But in the future, in the age of AI agents, clients won't buy software to improve efficiency. They will buy it for replacement. We are looking for tickers that possess vertical data gravity. Let's take a specific case, legal tech. GPT-4 or a future GPT-5 is smart, like a general law PhD, but it has a fatal weakness. It lacks your company's private contract data from the last decade, and it doesn't know the unwritten rules of your specific industry. However, there are legal tech firms using general models as a base, feeding them massive, exclusive, annotated case law data to train an AI super lawyer. What does this AI agent deliver? It can audit a 500-page complex commercial contract in 1 second, identify risk clauses, and automatically draft revisions. At this point, the company isn't selling a tool, it is selling a result. For a law firm, this means they no longer need to hire a junior associate with a $200,000 salary, emotions, and a tendency to quit. They just subscribe to the agent for 1/10 of the cost. This is where the profit comes from. When software companies start cutting into the OPEX operating expense pie, specifically payroll, the TAM total addressable market, explodes. They used to compete for the IT budget, now they are competing for the payroll budget. When picking stocks, don't look for companies that assist humans, look for companies daring enough to replace them. Focus on high barrier, high labor cost sectors, law, medical diagnosis, and financial compliance. Sector 2, Embodied AI. The second sector sounds like sci-fi, but its driver is cold, hard demographics. This is embodied AI, humanoid robotics. Why is Wall Street overweighting the sector now? Not because Elon Musk is hyping it. The real reason is the structural collapse of the global labor market. Look at the data from the US, Europe, Japan, and even China. Aging is irreversible. More critically, there is a shift in labor supply preferences. The younger generation refuses to enter factories, refuses warehouse logistics, and refuses elderly care. The blue-collar labor gap is structural. Wage inflation cannot fix a supply that simply isn't there. If LLMs, large language models, solve the supply of brain power, infinite code, and copy generation, embodied AI will solve the supply of physical labor. From 2025 to 2026, we will witness the iPhone moment for robotics. Why now? Because AI models have finally given robots a brain. Previous robots like Boston Dynamics had athletic bodies but zero cognition. Current VLA, vision language action models, allow robots to understand the world visually and execute semantic commands, not just follow coordinates. What is the investment strategy here? It is very specific. Short the hardware OEM, long the supply chain. Just like the EV wars, whether Tesla wins or BYD wins, the battery supplier CATL makes a guaranteed profit. In robotics, we hunt for critical component suppliers, for example, manufacturers of precision sensors. For a robot to have force control and visual feedback, it needs expensive tactile and visual sensors. Or consider data companies providing simulated training environments. This is Wall Street's hidden beta. Real-world training is too slow and expensive. Robots need to iterate billions of times in a sim-to-real virtual environment. Whoever masters the physics simulation engine and owns the most realistic synthetic data is the god of the robotics era. Sector 3, Tech Bio. The third sector has the highest risk appetite but the most terrifying potential. Alpha, AI plus biotech. The pharmaceutical industry suffers from a desperate E-Rooms law. Moore's law, spelled backward. Developing a new drug takes 10 years and burns $1 billion. With a success rate under 10%. Financially, this is almost an unsustainable gamble. But AI is transforming biology from an experimental science based on trial and error into a data science based on computation. Think of it this way. Making a key used to be a blind test, poking a wire into a lock thousands of times. Now AI, like AlphaFold, analyzes the 3D structure of the lock and generates the blueprint for the key instantly. Current AI drug discovery firms can screen billions of molecules in silico computer simulation, completing years of human work in days. This efficiency gain is exponential. If AI can compress the R&D cycle from 5 years to 12 months and cut costs by 90%, what does that mean for Pfizer or Novartis? It means an explosion in margins and the conquest of incurable diseases. We are observing Big Pharma furiously sending orders to AI startups via BD business development deals. Single deal values are hitting the billion-dollar level. The investment logic here is hardcore. We don't look for companies selling their own drugs, heavy channels, high risk. We look for companies selling algorithm platforms. They don't take the binary risk of phase 2, 3 clinical trials. They provide the algorithms and data, collecting milestone payments and royalties. This is a high-margin software business disguised as biotech. This is the incubator for my highest conviction 10-baggers over the next 5 years. We've dismantled the logic of the 3 sectors. Now, the critical question, as an individual investor, how do you execute this? I know, after hearing this, your dopamine is spiking, and you want to liquidate NVIDIA to go all in on small caps in these sectors. Stop. That is a typical retail impulse. Emotional trading is the source of all losses. The market regime of 2026 is completely different from 2023. 2023 was a beta rally, a rising tide lifting all boats. What comes next is brutal alpha divergence, a time to separate the wheat from the chaff. If a company only has AI concepts in a PowerPoint but no revenue support, it faces a valuation massacre in the next earnings season. I recommend the classic Wall Street barbell strategy for your portfolio. The left end of the barbell, allocate 50% to 60% of your capital as a defensive cornerstone. Do not completely dump hardware, but rebalance. Pay special attention to ignored sectors, energy, and utilities. AI is an electricity black hole. No matter who wins the model war, OpenAI or Google, they must pay the electric bill. Power stocks, especially companies mastering SMR, small modular reactors technology, are the water and electricity of the AI age. They offer wide moats and stable cash flow to protect your NAV, net asset value, during volatility. The right end of the barbell, allocate 30% to 40% for high odds offense. Distribute this capital across the 3 verticals we discussed: vertical SaaS, robotic supply chain, and AI pharmaceuticals. For most investors, I do not recommend timing individual stocks because technical uncertainty is too high. The optimal solution is to buy ETFs in these specific niches, or look for leaders deeply rooted in the field for over a decade and watch for a quarter-over-quarter explosion in AI subscription revenue in their financial reports. Let me leave you with a macro perspective. Every technological revolution is essentially a violent redistribution of social wealth. In the 19th century, wealth belonged to railroad and steel tycoons. In the 20th century, it belonged to oil and auto giants. In the early 21st century, it belonged to internet platform monopolists. But for the next decade, wealth will no longer belong to the makers of computing power, because compute will eventually be commoditized. Future excess returns will belong to capital that doesn't worship compute, but knows how to harness it to solve actual pain points, replace expensive labor, and create entirely new value. I'm an analyst who rejects fluff and focuses only on money flow. If you want to get the watch list for these 3 sectors, including ETF tickers and leader analysis, signal me in the comments. Like, subscribe. Let's position ourselves on the winning side of the next cycle. See you in the market.